So Irma, maybe you remember it as the hurricane that came through Central Florida several years ago, but many people are getting a hurricane-like impact on their Social Security these days as a result of this. Rob, what's the IRMAA that we're talking about here on this week's program?
All right, so IRMAA is short for Income-Related Monthly Adjustment Amount, and that applies to the amount of premium you pay for your Medicare premiums every month. And so they've come up with this system years back where, up to the first $109,000 of income, you're just going to pay the standard $202 in 2026. But now they got these thresholds in place. It says, if you start making more than that, you instantly start paying $80 or more per month on your Part B premium. And once you cross into the IRMAA thresholds, you start paying even more for the Part D. And so this is we're in tax season, people are starting to notice this. It's kind of odd because based on your tax return from 2 years ago determines on how much your IRMAA surcharge is going to be today. And so we find it to be a little complicated, and obviously clients are confused and concerned.
Well, it certainly gets your attention because when you get these letters from Social Security that says, hey, your Social Security is not going to be what you think it was going to be because we are having to withhold a larger chunk for the Medicare premium. We get that call a lot at the office when those letters go out, typically at the end of the year of the, looking ahead to that next year, where people say, how come they reduced my Social Security? And the reality is they didn't reduce your Social Security. They're just charging you more for how much you have to pay for Medicare. And key distinction, not only do you have to wind up paying more for the Part B as a result of that, but you also have to pay more for the Part D as well. So it can be pricey pretty quickly.
For the prescription drugs, right. They both get jumped in. We talk about on the show when we're leaning on the Social Security side, you get a cost of living adjustment, 2.8%. Social Security is going to go up, which it did. But then the amount of the IRMAA, the surcharge for your Medicare premium, went up more. So people are seeing a negative cash flow in their Social Security. So not only does IRMAA cost you more on your Medicare, reduces that monthly income that you might have been planning on using from Social Security.
Well, and the real kicker here is that oftentimes it's one issues that we see with this is obviously just kind of the normal income creep, right? I mean, your Social Security goes up a little bit every year, your required minimum distribution goes up a little bit every year. All of those things sort of gradually can push your income up with the concept of sort of that bracket creep where your income creeps up a little bit every year. But there's also all of those kind of one-off transactions, right? So you sell an investment property, right? Or you inherit money, or you wind up having doing a conversion or something like that. I mean, a lot of that is the potential for extra income that at the end of the day can really trigger a significant surprise based on how this IRMAA stuff plays out.
Sure, and even a change in tax filing status. If you were filing joint, you go up to for 2026 go up to $218,000. But if you're by yourself, it's only $109,000. So if you were generating a lot of the income and your spouse was not, and they pass away, now you're filing as an individual, you got a whole new thing to think about. And then what we notice is it's not really how wealthy you are as to how much you pay in Medicare. It's how much money comes out. And then when they do these calculations, so they take your adjusted gross income, then they convert it over to the modified adjusted gross income, which means takes and puts back in whatever you got in tax-free income from muni bonds. So then you're like, well, wait a second. The muni bond should have helped me for taxes, which it did, but then it kind of still can be used and thrown back in along with how much of your Social Security is taxable. So these things just add up quickly. And if you don't plan ahead, it really does catch you off guard.
Key distinction when we talk about income for IRMAA purposes, right, for this income-related Medicare adjustment, it's your adjusted gross income, but then you have to add back in the tax-free muni income to get to what is known as the modified adjusted gross income number that IRMAA looks like. So the conversation starts with AGI, adjusted gross income, which is a line on everybody's tax return. But know that with the IRMAA, you actually have to kind of add back in that tax-free muni income to get to the right income threshold that's going to determine how much you have to pay on of an increased Medicare premium.
Right, which means that tax-free income is going to be probably bump you up to another threshold.
And there's 5 different thresholds.
There's 5 different thresholds.
Each one sort of ratchets up, okay, higher and higher in terms of how much you have to pay for Medicare, Part B, Part D, depending upon income.
Right. Unlike the tax code where it says, okay, your first amount of income is taxed at this much. Oh, if you got more income above that, only that piece would be taxed at the next level. IRMAA goes from $1. If you're under $109,000, you're just at the $202. If you're on $109,001, everything now goes up to $285.
Yeah.
And it's not graduated. It's just boom, all at once. And every time you bump up a threshold, you end up having a full increase. And of course, years back, they compressed those thresholds, which meant, more people can jump brackets quicker. There are people paying $500 a month or more for Medicare. And today, they're just trying to live as a retirement person. Their income really wasn't that high, but 2 years ago, before they retired, it was.
Well, and Rob, that's a key fact of how all this plays out, and what's really the shocking part of it for most people is that look back period that you just alluded to. That's where a lot of the surprise comes from, because it is a little like a 2-year lag. Correct.
I mean, the Social Security goes to IRS and says, what was their income 2 years ago? They get it, whether it's right or wrong. Again, if you don't file your taxes correctly or you don't file it at all, they're going to go back to the previous tax return until they find one. And they're going to use that, and then they're going to send you a letter in November and says, here's what your IRMAA surcharge is going to be going into 2026. And a lot of people are like, they're caught off guard because 2 years ago was determining what's happening today. It's not very proactive. It's very reactive, like 2 years ago reactive.
Right. No. So what you're paying today for your Medicare premium 2026 is based on your completed tax return for the year 2024.
Correct.
And so one of the things that you want to be doing, because of course it is tax season, is that as you get your tax return done, take a look at where you are. Are you close to one of those brackets? Because Rob, as you were just saying, if you're $1 into the bracket, Jen, you're going to have to the whole year at that higher Medicare premium amount.
Correct. And if husband and wife filing jointly, they both are going to be looking at their income. So you want to manage income coming from spouse 1, income coming from spouse 2. Roth conversions, everybody's talking about how great they are because the end result is tax-free income. That conversion will bump you up to IRMAA. Now, once you have a Roth, sure, the income from the Roth is not counted, but when you convert it to a Roth, it's painful.
Yeah, no, because you really might have a much larger premium for that year period of time, and obviously, there's an appeal process which you can go through if it was sort of a one-off kind of thing, but that appeal process is not guaranteed that they're going to take your excuse.
No, and it's got to be something very unique. It can't be, 2 years ago when I was working, I had high income. Now that I'm retired, I have low income. That won't do it. Sometimes it's the sale of property. Sometimes it's the passing of a spouse. It's got to be a one-time event that's very unique. And then there's a form. I think it's the SSA 44. I've helped a couple of clients and prospects utilize that. And it's basically, this is my reason for asking for an exception. Here's my supporting documentation. It's a one-time event. It can be submitted. You have to be diligent, and you got to really spell it out. But we've had some success.
No, that is true. But I think bottom line, it all goes back to something that we say a lot on the program is that when you get your tax return done, don't just say, okay, great, I owe money or I'm getting a refund or whatever the case may be. You've got to sit down and kind of really look at the numbers and do the analysis. And just this past week, I was talking with somebody, and so they were concerned about the IRMAA and the impact. And we got talking, and I said, well, what are your plans for like next year, this year, next year, in terms of big expenditures? And they said, oh, well, we probably need a car next year. And so we looked at their tax return together, and I said, well, you probably want to take half the car this year, or at least the money for half the car this year, and then be prepared to just buy the car next year with the other half to stay below those thresholds.
Right, because if you looked at that, you probably could have said, hey, a full amount of the car withdrawal would put you at an estimated MAGI, and that would bump you up. Let's move some over to next year.
Important to plan ahead. I guess that's the common theme. Plan ahead. Make sure that you've got a strategy in place so that you can tackle all of these different issues. We're going to wrap it up on get on out of here. Thank you for listening to this week's edition of Dollars and Cents with Joel Garris and Rob Field of Nelson Financial Planning.